Hi folks, welcome back to the second part of our video for Grant and Lee. And in this question, to complete it, we need to do two things. We need to prepare a consolidated balance sheet, and we also need to calculate the value of the investment account in Lee on Grant's separate entity balance sheet if they had elected to record using the equity method, not the cost method. So in order to do the first thing, which is to do the consolidated balance sheet, we need to calculate consolidated retained earnings here in this part, and in the next part calculate NCI. All right, then we're in a position to tackle the next part, which is to put the consolidated balance sheet together. So let's begin that process. So now here in part F, we're going to calculate the consolidated retained earnings balance at December 31st, year 6. This balance will go on the consolidated balance sheet at the end of year 6 for Grant. So what do? We start with each separate entity's retained earnings. Here we have for Grant, the parent, $300,000, and we have for Lee at the end of year 6, $65,000. If you go back to the question, just in case you're wondering where we got these numbers, they are there in the separate entity balance sheets for Grant and Lee. You can see retained earnings for Grant and you can see retained earnings for Lee. So this information is generally given to you in the question. Now, we do need to make adjustments to Lee's retained earnings because don't forget, at the date they became related, that's Grant and Lee, that was at January 1, year 4. Don't forget, Lee already had some retained earnings that they had earned as a result of income they earned before they became related to Grant. Well, that does not represent any retained earnings that have been earned by Lee subsequent to the relationship with Grant. So we're going to not include or deduct the retained earnings that Lee earned before they became related to Grant. We're going to deduct it from this $65,000, which is their current end-of-year balance. We're not going to deduct it literally in the sense that it's coming off their retained earnings. This is just a calculation. So because we're looking for the post-acquisition retained earnings and taking our share of that as Grant, we only want to look at the retained earnings that Lee has earned while they've been related to us. So that $30,000 is what Lee, brought into the relationship on January 1, year 4, so we're not going to include it. The other thing we're going to have to deduct here are any impairment losses or acquisition differential amortizations that we booked from years 4 all the way through to the end of year 6. So where do we get those? We get those from part C of our question. So if you go back to what we did there in that very important schedule, you'll see that we started with an acquisition differential of $32,500 and we allocated it in part of what we amortized in the increment for inventory and patents over years 4 and 5, and then what we also amortized in year 6, which is $2,000 on the patent, and then of course we had an impairment loss on goodwill. All right, and that's going to give us $7,500. We've calculated this. We did this in the first video. So if you add up all these little guys here, that's going to give you the $18,500, which is the amount over time from years 4 to year 6 inclusive that we amortized or had impaired. And you'll remember what we did when we did our calculation of consolidated net income for year 6. We took the year 6 amounts here, and what did we do? The $2,000 and the $7,500, we adjusted Lee's income for that. Why that's important is, don't forget, any consolidated net income that we calculate, we have to close that out to consolidated retained earnings. Since in our question to calculate the ending balance of consolidated retained earnings, we're starting with a separate entity balance here, we have to remember that in years 4 to 6 inclusive, we also adjusted Lee's income for $18,500. So just like you learned in your intro financial accounting course, any income statement items or items that appear on an income statement all of those items get closed out to retained earnings. You learned this in your very first accounting course. Well, it's the same on the consolidated books. Any of these amounts in any one year, year 4, year 5, and year 6 in our case, those got closed out. On the income statement, they were included in income statement accounts. For example, here in year 6, they were included in distribution expense and other expense, right? Specifically. So we just had 9,500 here, adjusting our included in our calculation of consolidated net income for year 6. Previous to that, we had another amount, such that all those amounts that adjusted income from years 4 to 6 inclusive were 18,500. Well, each year that you closed out income, your income statement accounts, you closed out what you amortized of those increments as well, because they're in the balances, right? We're just seeing it here for year 6, but in years 4 and 5, you'd have to visualize you'd have done the same thing, right? So the idea here is that we now have to remember that since we're dealing with separate entity retained earnings, those guys, they didn't do anything separate entity. It's on the consolidated books, because we're calculating a consolidated balance, that we need to remember, hey, on the consolidated books, totally from years 4 to 6, we would have made amortizations of acquisition differential amounts as well as impairment losses of 18,500. That's why that schedule here is so important. It gives you what all of those amortizations are for each year. So it gives you your adjustments for income. So now all you got to do is add them all together to figure out cumulatively what did you adjust up to the end of year 6. And that's 18,500. So now we have that our post-acquisition, meaning after acquisition, so after Lee became acquired by Grant, post-acquisition, adjusted retained earnings. So post-acquisition is after we deduct 30,000. Adjusted is including this 18,500 deduction, which is going to give us 16,500. Grant only takes their share, which is 13,200 at 80%. So if we add 13,200 to 300,000, we're going to get consolidated retained earnings at 313,200. Now, that concludes the calculation of consolidated retained earnings that's going to go on the balance sheet. But we have to do one other very important amount, and that's NCI at the end of year 3 or year 6, because that also goes on the consolidated balance sheet. Now here you can choose to use either methods, 1 or 2. I'm going to go through them both with you, and you can use whichever one you feel more comfortable with on your assignment or in your testing, whatever you want. So now in method 1, what did we say? Well, NCI shareholders are shareholders in the sub. That's Lee. So what do we need to do here? Well, don't forget, the NCI is going to get its share of the fair value of Lee. Well, what's the fair value of Lee? The fair value of Lee at the end of year 6 is the book value of the net assets of Lee. That's its carrying value, which would be its shareholders' equity and common shares, plus any of that fair value increment that's yet unamortized. We're going to add those two pieces together and multiply it by 20%. So we get the common shares and retained earnings of Lee. That's the net assets, assets less liabilities. That's equity, right? And we're going to add the unamortized acquisition differential. Well, how much is unamortized? If you guys go back and look at this table, it tells you how much is unamortized. So you see, you go back to this table a lot to do a lot of things. So it is very important early on that you get the feel for the calculations we're doing and why they're important to your work. So now when we go through this, we're going to take this amount in brackets multiplied by 20%. We're going to get 20,800 for our NCI in the consolidated balance sheet at the end of year 6. We could now also do it a different way. We could start with our NCI balance at the date that they became related, and we calculated that back in Part A. You'll remember back up here. We'll just go up, right here. All right, it was 17,500. And don't forget, Grant, the parent, got its share of the post-acquisition retained earnings of Lee. That's 80%. Well, who got the other 20% of that? That must have been the NCI. So the NCI is also getting its share of the equity that was earned by the sub Lee since the date the two companies became related. So we're going to take 20% of that 16,500, which is 3,300, add it to the original balance of 17,500 at acquisition, and we also get 20,800. So sometimes by doing both calculations, it's a way to check your work to make sure you did it right. So now let's have a look at doing the consolidated balance sheet. So with the consolidated balance sheet here, we're going to start with cash. Now again, there was no change and no adjustments. We take the cash of the parent grant and add it to Lee's cash, and we're going to get 23,000 there, right? Now we're going to take the accounts receivable of grant, add Lee's to it. But don't forget, earlier in the question, if you go back to that, they said there something about the receivables being intercompany. Yeah, it says grants receivable contains 30,000 owing from Lee. Well, if grants receivables include money that Lee owes it, then Lee must have an account payable on its books. So that debt is owed by Lee to Grant. Grant has a receivable, right? Lee has a payable. So what we're saying is that these are not accounts receivable and accounts payable with outside third parties from the consolidated entity. So what we need to do is we need to eliminate it from our balances. So if you go back to the solution, what you'll see here is that we've removed the 30,000 from the accounts receivable balance to get to 37,000. And if we just want to slip down here to the accounts payable, we did the same thing here. Because don't forget, in this 195,000 of accounts payable is 30,000 owed to Grant. Well, that's intercompany. It's not with outside third parties, so we eliminate it. On the worksheet, what would you do? You debit Lee's payable and you'd credit Grant's receivable. Notice that because the payable account is on Lee's separate entity books and the receivable is on Grant's books, it should be very clear to you that this worksheet entry is not getting posted on anybody's separate entity books. It's only going to show up on the consolidation worksheet, right? It's just a working paper entry. It doesn't go on Grant's books or Lee's books. It can't, because we're involving two different accounts, one from each company's books, right? So now let's get back to the assets. The inventory, we add the two amounts together because don't forget, consolidation is an additive process. We add together the equipment values. We add together the patent. Don't forget, Grant didn't have a patent, right? The patent that Lee had, if we go back to the original data, right, we had a patent sitting on Lee's books at 2,000. Okay, at the end of year 6, that's what they've got on their books, right? So what we would do is we would add that in, but don't forget, there was an increment that we were amortizing on that patent, right? Not all of it is yet amortized. How much is still yet to be amortized? Well, if you go back up here, again, we go back to that all-important schedule. It's right there. So we have to include that because don't forget, the parent Grant bought the fair value of Lee's net identifiable assets. Patents are identifiable. That's part of the remaining fair value that needs to be amortized. So don't forget, we have to include that on our consolidated books. So that's going to give us a total of 6,000. Goodwill we already had from the same Part C. That's part of the recoverable amount of goodwill, right? 10,000. So we're going to have a balance sheet here with the total assets adding up to 1,121,000. If we look at the liabilities, we see our liabilities again. We talked about the worksheet entry to eliminate the account payable. That's intercompany. Once we do that, we're going to get 355,000. We add together the accrued liabilities of each entity to get 110 for the consolidated books. Add each entity's income tax payable to get 152,000 on the consolidated books. And remember what we talked about so long ago in our course and that we did today. We're only going to take the common shares of the parent Grant onto our books. Why? Because we're doing these consolidated statements for parties that are interested in Grant, right? We're not the only party interested in Lee's okay, is the NCI, right? But the shareholders of Grant are interested in the common shares of Grant. So we're only going to put the common shares of Grant in there, which we can see from our year 6 statements. If we go back to the question, common shares, 170,000. So we're getting it right from the question, right? We calculated our retained earnings in Part F and our NCI in Part G. So you can see we get total liabilities and equity of 1.121 million, which is exactly what we should get, right, for a balanced balance sheet. Now I made a note here. I just want to explain it. I double asterisked it. And just to say, notice in the assets section, there is no investment in Lee account. Why? Because don't forget, we eliminated it at acquisition, right? So don't forget, that's a worksheet entry that gets posted to the consolidated books. So from a consolidation perspective, that investment is made up of all of the carrying value that we now control of Grant since at the date we became related, which is the carrying value of net assets, right? We also had the fair value increments, right? So the carrying value of Lee plus the fair value increments that we assessed on the inventory and the patent, that was also part of what we paid for. That was part of the value of the investment, right? And there was also goodwill. We paid a price over and above. That 70,000 was over and above, and that because that included goodwill. So that's why you don't have any investment in Lee account. Under the cost method, don't forget, you're not going to have that investment in Lee account, right? You're not going to have that on the consolidated books. Now, don't forget, you would have it, though, on Grant's individual books. In fact, you can see it here. It's right here, investment in Lee. It's right here, 70,000, right? That's their separate entity books. But don't forget, on the consolidated books, you're not going to see it because it's broken up into all of its little pieces, right? Don't forget, we eliminated the common shares and retained earnings of Lee. That's all part of that investment, right? We set up our goodwill, and we also set up our fair value increments on the inventory and the patent. That was part of what we bought. So that's where we get the 70,000. We're going to eliminate that 70,000, right? Because it's all subsumed in these amounts here, right? So that's why we eliminate it. So now, if we go back to the balance sheet, that's again why you don't see anything here in the investment in Lee account in the assets section. So this concludes part 2 of our video. For the third part, it'll be a shorter video, but it'll go through some elements of the equity method so we can get an idea of how the investment in Lee would look different than it does on the cost method if we were to use the equity method.